Welcome to the deep dive. Look, we all know there's just a flood of information out there every single day,
Mm-hmm. It's overwhelming.
especially when you're trying to track global markets, economies. It feels like you need a PhD just to keep up sometimes.
Definitely.
So, our mission today is pretty straightforward. We've got this market brief here, dated August 18th, 2025, with data from the 15th.
Right.
And we're going to basically pull out the really important stuff, connect the dots for you.
Yeah, cut through the noise.
Exactly. Help you understand what it actually means. Because right now, the big tension is, U.S. inflation, what the Fed's going to do,
Mm-hmm. The September meeting looms large.
and how markets everywhere are reacting. And sometimes, well, in pretty surprising ways.
Absolutely.
Okay, so let's get into it. The big thing last week, obviously, was a U.S. July CPI report, Consumer Price Index.
Yeah, that was the main event.
Now, first glance, the numbers seem okay, but there's more going on under the hood, isn't there?
Oh, definitely. It's quite nuanced when you dig in.
So we saw headline inflation up 2.7% year on year. That was actually like a little below what people expected.
Right, a slight undershoot on the headline.
But then core inflation, stripping out food and energy, that rose 3.1% year on year. And that was a bit above expectations.
Exactly. And that difference, that's where the interesting story lies.
How so?
Well, what's fascinating is why. While the overall headline number cooled a bit, core goods prices actually jumped quite a bit month on month.
Ah,
And that looks like what people are calling tariff pass-through.
okay. Explain that a bit.
It basically suggests those import tariffs, the costs are now really starting to show up in the prices consumers pay for goods.
Yeah.
Businesses aren't absorbing them as much anymore.
Gotcha. So supply side pressures are still definitely a factor.
Very much so. It's not just a temporary thing.
Okay, so if core goods were pushing things up because of tariffs, something else must have been pulling that headline number down. What was it?
Yeah, exactly. There was an offset.
Yeah.
And it came from services inflation, which continued to soften.
Ah, okay. Like what specifically?
Well, rental growth, for example, that's still normalizing, coming down gradually.
Right. Which must be helpful for the Fed.
It is. It gives them a bit more breathing room, lets them maybe focus on those other pressures. But look, despite these kind of mixed signals, some bits cooling, others heating up,
Yeah.
this report, it really didn't do much to change the minds of Fed officials who were already thinking about cutting rates in September.
Okay, so the path seems kind of set, barring any major surprises.
Well, combine this with the recent labor market data, pointing to softer job growth.
You're right. That came out recently, too.
Yeah. So the probability of a September cut, it just keeps building, really.
So for anyone watching the Fed, it's all eyes on the next jobs report and the next CPI numbers, both due out in September before that meeting.
Absolutely critical couple weeks coming up.
Okay, so that's the U.S. picture, nuanced, leaning towards a cut. But we know this stuff doesn't happen in a vacuum.
No, definitely not.
How does this ripple outwards? What should we be watching globally in the coming week? What's the wider economic pulse telling us?
That's a really important question. How in sync are these global economies right now? If we step back, look at the bigger picture, this coming week is actually full of potentially market-moving data points from around the world.
Okay, like what?
Well, on Wednesday, we get the UK's inflation numbers headline CPI and core CPI for July.
Right. What were they before?
Prior figures were 3.6% and 3.7%. So we'll see if the UK is following the US trend or if inflation is proving stickier over there.
Okay, UK inflation Wednesday. What else?
Then Thursday is a big one for activity indicators. We get composite PMI data.
Ah, Purchasing Managers Index. Remind us quickly what that tells us.
Yeah, it's a key survey. Basically measures economic activity and sentiment. Anything above 50 means expansion, below 50 contraction.
Got it.
So we'll get August numbers for the Eurozone. That was 50.9 before, so just barely expanding. Japan was 51.5, UK also 51.5. The US was much stronger at 55.1.
So quite a varied picture there already. US strong, others just sort of hovering.
Exactly. Suggests maybe some fragility, particularly in Europe and the UK. Also on Thursday, we get Eurozone consumer confidence. That was really low before, negative 14.7. So that tells us about potential spending.
Okay, and the week wraps up with...
Friday brings Japan's core CPI for July. Their prior was 3.3%, so they're battling inflation too. Then UK consumer confidence, again, pretty gloomy at negative 19 before.
Yeah.
And UK retail sales for July.
Which were up 1.7% previously, so a direct look at spending there.
Yeah. All these international numbers, they're crucial because they paint that wider picture of global health and sentiment in one major economy can definitely spill over.
Absolutely. Okay, so against that backdrop, mixed U.S. inflation, potential Fed cut, varied global signals, how did the markets actually react? This is where it gets really interesting, right?
Yeah. Let's look at the numbers as of August 15th.
So overall, equities seem pretty positive. MSCI AC World Index was up 1.2% for the week.
Yeah, and up nearly 12% year to date. So broadly positive.
Yeah. But when you dig down, wow, look at the IBEX, the Spanish index, up 3.1% just in the week.
Incredible, isn't it? And look, year to date, 35.7% over the last year, 46.4%.
That's huge. Serious confidence in Spain, it seems.
It certainly suggests that. And look at MSCI China, too. Big gains there as well, up 28.3% year to date, 49% over the year. Maybe some renewed optimism there.
Could be. Now, sector-wise, this caught my eye. Healthcare up 4.2% in the week.
Yeah, that's a standout move.
Especially because year to date it was basically flat, only 0.2%, and down over the year. What do you make of that sudden jump?
Well, it could be a couple of things. Maybe a rotation, investors moving into more defensive sectors if they're worried about the economy.
Plausible.
Or it could be something specific to the sector, maybe good news on drug trials or policy changes. Hard to say for sure just yet.
Interesting. And technology, usually a leader, took a slight step back, down 0.1%.
Just a tiny dip. Maybe some profit taking after a strong run or just reevaluating those growth stocks.
Yeah.
But communication services stayed strong.
Right, up over 21% year to date, nearly 37% over the year. Consistent demand there.
Seems so. Digital world, right?
Okay, let's shift to bonds. Spreads narrowed, you said. Global investment grade down 4 basis points in the week. What does that mean in simple terms?
Yeah, so a basis point is just 1/100%. So 4 basis points isn't huge, but narrowing spreads basically means the perceived risk of companies defaulting on their debt went down slightly.
Okay, so slightly less risky, slightly cheaper for good companies to borrow.
Exactly. And year to date, those spreads are down 12 basis points.
And what about government bond yields, the 10-year notes?
Bit of a split there. U.S. 10-year yields were down 4 basis points in the week and down 25 basis points year to date.
So borrowing costs easing in the U.S., generally good.
Generally, yes. But interestingly, 10-year yields in the UK, Germany, and Japan all rose over the week.
Huh. So different expectations or inflation worries in those places compared to the U.S.
It suggests that, yeah, different central bank paths potentially being priced in.
Fascinating. Okay, commodities. Gold keeps shining, doesn't it?
Absolutely remarkable performance, up over 27% year to date, 36% over the last year.
Wow. So it's still a big demand for safe havens or inflation hedges there.
Seems like it.
Yeah.
And Brent crude oil, it was up a tiny bit, 0.4% in the week.
It's still way down for the year, right?
Yeah, down 10.5% year to date, almost 18% down over the year. Suggests ongoing worries about global demand, perhaps.
Right. And quick final checks, market volatility, the VIX.
Still pretty calm, stable around 15, so the market isn't pricing in big swings right now.
Okay. And that macro snapshot, US GDP at 3.0%, CPI 2.7%. But China...
Yeah, this is striking. China's GDP reported at 4.5%, quite healthy growth.
But their CPI...
0.0%, flat.
Wow. So deflationary concerns there, maybe, while the rest of the world battles inflation?
It's a very different picture, certainly raises questions. And lastly, S&P 500 forward PE ratio.
22.5, still pretty high.
Yeah, it suggests investors are still expecting strong earnings growth ahead, pricing in quite a bit of optimism. So if you pull it all together, you really see this diverse global picture, don't you? Different regions moving differently, sectors rotating, bond markets, sending mixed signals depending on geography.
Yeah.
It's all reacting to these varying inflation pressures and what people think central banks are going to do next.
It really is a complex dance, isn't it? Influencing everything from, the cost of your groceries to your long-term investments.
Absolutely.
So just to quickly recap then, we dove into that U.S. inflation picture headline down a bit, but core goods up, maybe tariff pass-through.
Offset by services, especially rent, cooling off.
Right. And that mix, plus softer jobs data, keeps the Fed pointing towards a potential September rate cut. So watch those upcoming reports.
Definitely.
Then we looked globally. Lots of key data coming from the UK, Eurozone, Japan this week, CPI, PMI. It'll give us a clearer sense of whether everyone's facing the same headwinds.
Yeah, how synchronized things really are.
And finally, the market reaction. Generally positive stocks, but big variations like Spain booming, healthcare jumping.
While tech paused, and bonds showed narrowing spreads but diverging yields globally. Gold still strong.
Right. It really highlights how different parts of the market are interpreting all this data and positioning themselves.
I see.
Look, we hope this deep dive served as that shortcut for you, helping you feel informed, get the key insights without drowning in all the raw numbers.
Yeah, making sense of the important signals.
So, as we finish up, here's something to maybe mull over. With all this complex interplay, inflation, policy, market reactions, what kind of unexpected shifts may we see next? Maybe from consumers or supply chains finally easing up more?
Interesting question.
How might some of those smaller micro trends suddenly become the next big macro force to watch? Something to think about.